Thank you. I'm going to go to Rushanara, please, now. Rush.
Good afternoon, and thank you. My questions are follow-ups to the chairs and the ones that Felicity asked. So, Governor, in the previous sessions, you talked about there being no such thing as frictionless trade. Obviously, we're all relieved to have got a deal, not least because of warnings that you provided and others provided at the dangers. But could you say more about whether you think, what you think the costs? We know the benefits of getting some stability, but what are the costs now? Now that we have an actual trade agreement, the OBR said in its analysis that a typical free trade deal would cost, long-term, would cost us around 4% of GDP. Would you say that's still the case, or is it lower, or is it likely to be higher?
Yeah, no, thanks. I mean, it's a very good, very important question. So, broadly speaking, well, actually, broadly, pretty much the trade agreement that has been agreed is the one that certainly we were expecting, and is pretty similar to the one that we had factored into the monetary policy report in November. There may be a few tweaks in areas like rules of origin, which might have a small positive sign on them, but in overall GDP terms, I don't think it makes a lot of difference. But by the way, we will do the full analysis of that for the February monetary policy report. I'm very happy. Obviously, I think we're going to have a hearing on that, so happy to come back with a fuller answer to that when we've done the analysis. But you're right. I mean, you're right in saying that, of course, I said frictionless trade, because although obviously, and very importantly, by the way, this agreement means that there are no tariffs. There are, there are non-tariff barriers. I mean, there are forms to fill, as it were, and there is sort of grit in the mechanism there. Now, I should say, by the way, that it is really too early, I think. There's a lot of reporting about this. I think in all our assessments, and we've been talking a lot over the last, of course, this week to people, it's too early to assess that at the moment. If I can give you one illustration of that. One of the things that we monitor carefully, and by the way, were before Christmas for the other reason, the COVID reason, is port traffic. So looking at HGV traffic around Dover and Eurotunnel, for instance, there is a seasonal pattern to it. So based on looking at the movement data of lorries over the past 3 or 4 years, we wouldn't expect it to come back to a sort of more normal level in any year until about a week from now. So I think that's consistent with people saying there isn't much around.
Going back to the 4%, would you say that it's likely to remain around 4%? And
well, that's what I mean. No, you're right. Oh, look, I mean, most models, OBR is right. Most models give you something like that. I mean, I think we put in our numbers. I think that in the third year, which is the tail end of our monetary policy forecast, the modelling would give you about just over 2% on GDP. But you're right that the OBR and indeed our model, when you let it play out, because these effects are very long run, by the way, because they're the way in which the real side of the economy adjusts. There's something around 3 to 4% for this sort of deal is probably right. And of course, the whole question then, of course, is that's what the model tells you. Of course, what actually will happen depends on how quickly the adjustment process. Well, first of all, actually, it depends on how much disruption we see in the next few weeks and month or two, and then it depends on how quickly the economy adjusts to the new trading arrangements.
Thank you. I'm going to move on to a question around investment. This morning, Professor Catherine Barnard gave evidence in another committee, and she said that she described the deal as very unstable, according to press reports, given the shaky foundations of the agreement, which can be terminated for numerous reasons. We've already talked about some of that. Are you concerned that these shaky foundations could influence companies? Of course, we're pretty early on in their decisions to invest in the UK in the short, both short, medium term and longer term, and if others could come in as well on that.
Well, I mean, it's a big agreement. It's a big agreement on trading goods, particularly, and I don't think there's any cause at the moment to particularly sort of reach a judgment one way or the other on its foundation, or particularly question its foundations. Actually, Now, I think of course, the question that is rightly raised about, well, how easily can it be walked away from, if you like, taken away? Again, because we've had this with financial services as well, one would hope that there is a spirit of goodwill and common sense that is a very stupid thing to do. I think we go forward with saying, certainly on the trading goods side, this is a comprehensive free trade agreement. Now, you're right then, and of course this is key because we've had a very low rate of investment in the economy now for really about the last decade, and you can put this down to a number of things. You can put it down to coming out of the financial crisis. You can put it down to some longer term global trends, actually. But of course, I think uncertainty caused initially, around the referendum, but then going to how Brexit was going to play out. Uncertainty undoubtedly, with lots of literature on this, reduces investment, because if people can put off the decision until the future when they know more and are more certain they will do that. So it's important for the economy, and particularly, by the way, coming out of COVID, critically coming out of COVID, frankly, that we see a reduction in uncertainty and therefore stronger conditions for investment. And as you say, that the trade agreement supports that.
But the reality is, the point being made here is that it's unstable. And it is unstable, isn't it, compared to what we had before, not least in relation to financial services. And unless this MOU is agreed, and unless, as you say, both parties can see the benefits of having stability in relation to financial services, then we are going to have an unstable set of circumstances for investment, are we not?
Well, I have to be honest with you, I haven't seen what Catherine Barnard said this morning, so I can't really comment on how she described that uncertainty.
About just giving your own perspective then.
Well, I think you can get, if you take financial services, we can get certainty by not having equivalence, and we can get certainty by having equivalence. I said before, I think it would be much better for both sides, actually, if we have open markets and therefore certainty that way. But if we don't, then of course the markets and firms will evolve, because, and particularly in financial services, because we're a global financial centre, they will evolve to do other things.
Yeah. The evolution of that will cost us, won't it? And your point earlier about rule taker versus the language of, I suppose, there's a question about whether the language of being a rule taker or becoming, and in the negotiations around an MOU, whether that's appropriate anymore, because they now increasingly hold the cards, because our government focused much of its energy on getting an agreement on fishing, and some would argue should have spent as much time and energy on getting a deal and stability around financial services. We are where we are, but the question is, are we actually going to end up being a rule taker on financial services? Is it wishful thinking to think that we're not going to be, given that they now hold the cards?
Well, I have said quite a lot of times in this committee, but I'm happy to say it again, that I would strongly recommend that we do not become a rule taker. I think that is a very bad place to end up in. And I mean, if the price of that is no equivalence, then I'm afraid that will follow. Yeah. But I think that's the wrong outcome for both
others like to
and the UK. But if that's where it goes to, and we just can't, I'm afraid I'm strongly, as you've heard me say as many times, I know I'm strongly opposed to rule taking.
I think Sam wanted to come in. Sam?
Yeah, Ms. Ali, I don't think we're on that rule taker path at all. And I don't think the MOU is going to take us to that place. I think the MOU, the aim of it will be to help strengthen exchange of ideas and dialogue between the two sides. But there is an absolute recognition, as Andrew said, that both sides need to evolve their rules. They'll do so in their own way. And as to instability, I mean, the problems around instability are much worse in equivalence than they are in an FTA. And that's one of the reasons why, when we've looked at the trade-off between, if you had to be a rule taker to get equivalence, you'd be crazy to do that deal.
I mean, can I just give you an example, because it may help to illustrate this? And I'm sure there will be examples that that the EU will come up with. But the EU has very recently adopted a rule, Sam will correct me, that allows to count within banks' capital the value of capitalized software, their own software. Now, that is against the Basel Accord. And we're just not going to implement that rule, because it's unsound. Because I'm afraid come the day when you need the free capital, and I emphasize the word free there, I don't know how you think you get the value out of your software at that point. So, we're not going to do that. Now, I'm sure they'll come up with something we've done that they'll say, it doesn't make any sense. I can't think what it is, obviously, because we haven't done anything that doesn't make any sense. But the point being is, we're just not going to be in that situation where we take rules like that.
What we can all agree on is we're going to be in a period of a constant negotiation, actually, and the end of the matter is not at the end of the agreement of the agreement on the trade agreement. Can I just bring in Donald Cohen, Mr. Cohen, on any reflections on any of those points, but also what is it? Any reflections on the US experience and whether what all of this means for a trade agreement with the US? And then I'm going to stop.
So I think my reflections very much match Andrew's reflections on the discussion you just had and the rule taking. I think the Financial Policy Committee has been very clear and has repeated many times since the referendum that we need to be able to make the rules and make the recommendations that protect financial stability in the UK, and we need to have the freedom to do that to hit the objectives that you, the Parliament, have set for us. And so being a rule taker will not meet that criteria. We need to be able to make the rules to fulfill our duties that you've given us. I think in terms of a free trade agreements, say with the US, are hard to negotiate. It's a tough slog. Agricultural interests are important. I've been eating chlorine washed chicken all my life, and I think it's okay, but I think that's for UK citizens to decide. So there are a lot of interest in there, but I do think it's important to be a little bit serious here, that that the US engaged with the UK and that the UK engaged with other countries to increase the flow of goods and services between us to benefit the people that reside in our countries. So the negotiations will be tough, but I think both sides can benefit from a free trade agreement.
And Anna wanted to come in quickly, I think, and just we might have to move on. But
and just I want to reemphasize something Andrew said at the very beginning, which is a lot of the direction of travel for all the financial regulation will come from global bodies. It's not like the EU can hold the UK hostage. They do have to comply with the same things through the Financial Stability Board, the list of all the other regulators. So we shouldn't lose big picture. That's what's going to drive things. And the FPC can be a leader in thinking on a lot of these regulatory issues, and we intend to carry on doing that. So I think, that's a very important baseline to keep in mind.
Well, thank you. Thank you very much.
great.